Thank you, and welcome everyone to Preparing for Financial Uncertainty. Is your staffing firm prepared for the unexpected? Today, we're going to look at what lies ahead for staffing, explore some new revenue opportunities, and find out how to be smarter with your money and taxes. Do you believe, Jeremy? Do you believe? Okay. Now let us get to our logistics. Peter just went through some logistics. The main thing is we love for you to ask questions. If we don't get to your question now, we will get back to you after the webinar. You can listen to the audio on your computer or you can dial in either one. And of course, closed captioning is available. If you have technical questions, Peter is standing by, our WebEx producer, to answer those. In terms of our products, a little bit about the SIA world. If you don't know already, we're the global advisor for staffing and workforce solutions, and we offer a range of research, events, and editorial products for staffing firms and buyers that are focused specifically on staffing and solutions. Our members enjoy access to our objective research and analysts, event discounts, editorial publications, and advisory services. I see many of our members today. Welcome and thank you for attending. If you're not a member, please contact member services at staffingindustry.com to find out more about membership. And speaking of upcoming events, Executive Forum is just around the corner, my friends, and Advanced Partners, who is sponsoring and presenting this webinar today, is a platinum sponsor there. So visit them and all of us there next week at the Aria Resort in Las Vegas, Nevada. Our speakers today. I want to introduce you to Michael Schultz. He's our first economist at SIA. And Michael, welcome. Tell us a little bit about why this topic might be so important to you.
Well, something I think everyone's observed is over the last year and a half to 2 years, the normal statistical and economic relationships for the staffing industry have essentially disappeared. And that makes it a lot harder to plan for and interpret the ebbs and flows of the industry and what's happening with its clients. And that, of course, makes it all the more all the more important to prepare for uncertainty.
Great, thank you. And Jeremy, I believe you tell me why you think this topic is so important, especially now.
Well, underscoring everything Michael said, I completely agree with him. As a veteran of this industry for just under 20 years, being at Advanced Partners, we're seeing some counter-cyclical events, probably some aftershocks from the pandemic that are kind of hard to explain. And one of the things that we do at Advanced Partners, not only providing capital solutions, but consultative services, sometimes a shoulder to cry on or high five through the phone or in person when something great happens. And it's been a roller coaster the last couple of years. You know, the title of this presentation is about uncertainty, and there's always some degree, but we're all about 4-year survivors of the uncertainty of the pandemic, and it's a great opportunity to check in and kind of level set some things here today and talk through what's happened and try to figure things out and plan, which is really a big part of what I'll be talking about. Just to give a quick sense of our overlay of the market, we have roughly 500 clients, of which their top line in 2023 was just over $6 billion in sales. So we have a pretty good purview here of what's going on in the industry, but we don't know everything, and that's why SIA is a wonderful organization that we lean on. We encourage our clients to lean on to try to make some sense of what's happening and plan for the future.
Well, thank you for that, Jeremy. We appreciate that. Let's just get on with the show here. Let's see if I can get this slide to advance. There we go. The only thing that is certain is uncertainty, my friends. 4 years ago, almost to the day, we entered one of the most unusual events in my lifetime, as Jeremy mentioned, the pandemic. But Michael, tell us what's uncertain now.
So, echoing what both Jeremy and Adrian have said, probably for all of us, the period of greatest uncertainty in our lives is going to have proven to be the last 4 years. especially in 2020. No one really had a clue what was going on or what was going to happen, what the outcome could be. So I do quickly want to provide a little table setting for what is risk and what is uncertainty. Risk and uncertainty differ in terms of how much information you have available. With a risky situation, you can kind of know what the possible outcomes are, what the relative likelihood of an outcome among that range is, and then usually there's sufficient information you can either self-insure or go purchase insurance. The risks are well characterized. With an uncertain situation, usually there is so little information, it is not possible to know the range of outcomes. What might happen is essentially unknowable. So you can't identify the likelihood of the outcomes, and you can't go get insurance to protect you against a bad outcome in the end. Looking forward in 2024 alone, we've got a lot of uncertain events. I know Jeremy's going to talk about some of these later on, so I won't steal his thunder there. But some main ones, there's a lot of elections coming up. There's also the path of monetary and fiscal policy, which will impact the entire economy. There's ongoing weakness in some of our global trading partners. So a lot of European countries just were in or have just come out of recession and don't quite know what the rebound will be there. Quite a bit going on. And with that, I'd like to get into the economic trends portion of this presentation. During 2022 and 2023, to me it was surprising, but everywhere people were talking about, are we in a recession? Are we going to be in a recession? What's going to happen? And just want to provide a little bit of a look back. A lot of people use a rule of thumb that a recession is 2 consecutive quarters of negative GDP growth, but that is not the actual definition. There's a much wider range of data points that are used to identify the start of a recession and its ending. The 4 main ones used are presented here in the slide for their recent trends. And 2 of them, so personal income excluding support payments made by the government, and industrial production had a good bit of weakness in 2022 and in 2023. The others, there was some slowing, but recession really wasn't in the cards there. And I do find it a bit ironic that with how much deceleration we've had, now all of the concerns about recession and the headlines about it have kind of disappeared, but to me, I think it's more likely in 2024, 2025 than it was in the past 2 years. I do not mean that to say it is likely, though I want to clarify. So if you're curious what is going on, what's the risk of an economy-wide contraction, these are things that you can just readily find online and follow yourselves. It's data from the Bureau of Labor Statistics, Bureau of Economic Analysis, and the Federal Reserve. Then, for the overall labor market, seen strong employment growth continuing for the past several years. The layoff rate is actually at about a 50-year low, despite a lot of media sentiment indicating otherwise, but journalism and news media has been pretty hard hit for secular reasons. Then the percent of workers in a full-time job is also near the highest since the 1970s. In 2022, it was its highest percentage of total workers since 1979, and in 2023 it was only down 25 basis points from that. There is still much more labor demand than workers available. Pre-pandemic, the average month had about 200,000 more people looking for work than there were jobs available. And in 2022, the labor shortfall was on average 5.2 million more jobs than people working or looking for work. In the fourth quarter of 2023, that declined back down to only 2.6 million more jobs than people working or looking for work. In short, the aggregate labor market environment is one where historically staffing has been incredibly strong. And we can look directly at what's happened with staffing, with temporary help employment here, and overall employment in the US economy. It's a bit of a retrospective again. Usually these move pretty closely together. You don't get a big divergence. You don't get a persistent divergence. They'll move separately towards the start of a recession over the past 20, 30 years, but not long term. That's a situation that exists for a few months at most. And instead, as mentioned at the start, the normal relationships between staffing and the general economic data has broken down quite severely, which leaves everyone pretty well confused, understandably. But if we dig down a little deeper, instead of looking at this aggregate data, if we look at data specific to client verticals and what's happening in them, it's not as much of a mystery. So something more arcane and obscure is looking at overtime in manufacturing as a major client vertical. In the BLS data, those figures are headcount by number of workers, and the largest segment in staffing by number of workers is industrial, which is primarily then transportation, material moving, warehousing, and manufacturing workers. So manufacturing and the rest of the client base for industrial staffing has actually been very uncharacteristically weak for how strong the overall economy is. And the declines in staffing overall line up pretty well with that weakness. Going forward, of course, GDP growth is still good for staffing, even if it's not transferring through as much as it used to. But the outlook for staffing and the outlook for GDP is still fairly uncertain. The Federal Reserve Bank of Philadelphia has a survey of professional forecasters. Around 30, 40 people participate, or groups participate in each panel wave. And overall, professional forecasters anticipate the soft landing scenario, that GDP growth will slowly come down and will wind up at about 2% growth on a consistent basis into the future. But I wanted to highlight that even groups of forecasters where this is all they do have a lot of disagreement. The dotted yellow line and the dotted red line, they're the top and the bottom on this graph, represent the worst case scenario and best case scenario from that panel of forecasters. And that is about a 5-point gap for 2025 Q1 growth. And with GDP, a 0.1% gap is pretty massive. So even among professional forecasters, there's a lot of disagreement, though most of the cohorts in this survey line up at around 2% growth going forward. For one of the main events coming up in 2024, we all expect cuts to the benchmark interest rates by the Federal Reserve. Inflation, black line here on a year-over-year basis, has been declining back down towards the target rate of 2%. On a month-to-month basis, the trends are it's already back on target. There are a few different monetary policy rules. Those are basic formulas for given economic data, what should the interest rate be? All of them have interest rate cuts coming up, varying levels of aggressiveness on how rapidly cuts happen. Now, for staffing companies, if you have debt or you make use of commercial paper credit markets for your business operations, of course, interest rates have a direct impact on your business and your balance sheet. But even for companies that don't use any kind of external financing, you're still impacted indirectly by these interest rate scenarios. So a lot of the client industries are moderately to extremely interest rate sensitive. Through a few different channels apply. Higher interest rates lead to higher exchange rates. That makes exports for manufactured products less competitive in the global market. Less manufacturing activity, less need for workers in manufacturing. Similar applies, imports get cheaper, so less need for domestic manufacturing for domestic clients. For information technology and the tech sector broadly, there's also a lot of interest rate sensitivity because higher interest rates go down to lower equity values, less financial activity, less venture capital available, and so you get depressed activity in the tech sector.
So Michael, I'm wondering what Jeremy's clients think of this. Jeremy, what are you hearing out there?
Hearing a whole lot. This graph does a really nice job of illustrating the black line there. So the increase in the Fed funds rate, how quickly this all happened. There was nothing, in my opinion, that was subtle about the increase in rates that followed the pandemic and thereafter. And one of the things that I've been trying to brace our clients for and just talk through is, first of all, I think the worst is behind you. That's in the rearview mirror. There are a handful of people who think rates are going to go up. I'm not one of them. I think most people think they're going to come down, but it's going to be subtle. Unless something catastrophic happens again, which by golly, I hope it doesn't. On the 4-year anniversary of, we know what happened. And when things settle back in, the monetary policy is going to be such that it's not going to be the days of banks being able to borrow money for free from the government. So it's going to be somewhere in the middle, probably closer to where it is right now than where it was 4 years ago before the run up. So I'll talk a little bit more about understanding that element of the business. What you're getting, what your borrowing costs are effectively. But there is some relief coming. It certainly seems that. And I guess another advantage of that is your clients that are paying you, that owe you funds on services rendered, their access to capital is going to be at a more affordable rate too. So that should help with default rates. So there are good things coming. I truly believe that.
A positive attitude. I love it. Michael, what about those large client verticals? What's going on there?
So we can look at recent trends in employment as kind of a summary indicator of what's happening with clients. I mentioned already the manufacturing and the rest of the major verticals for the industrial segment have been uncharacteristically weak. Manufacturing, I think a lot of that is related to interest rates and exchange rates. And then, of course, also you have credit channel effect where the consumers buying manufactured products, especially, say, vehicles, appliances, furniture, a lot of that's financed. Interest rates are very high compared to where they were 5 years ago. People have a harder time getting access to loans or affording such a large loan payment. So they either scale down to a cheaper version of a product or they just have to delay or avoid that purchase altogether. Again, depressing manufacturing output. Of course, transportation material moving is closely intertwined with both trade and manufacturing. So less activity and less international trade. Those unwind a bit. Those Jeremy mentioned earlier, continuing unwinding of pandemic impacts as well. And one thing that provided a lot of support to the industrial segment during 2022 and 2021 was the massive shift from brick and mortar retail to e-commerce. That is continuing to unwind gradually, but warehouse employment overall is actually falling continuously over about the past year. Maybe a bit longer than that, top of my head, I don't quite recall. But
really? I wouldn't have thought that based on my Amazon orders, but okay.
A lot of people are going back to brick and mortar retail, and it's also just, wow, we all spent a lot of money setting up a home office, for example, but that's also something we only need to set up once, hopefully.
Yeah.
Then for IT, I mentioned there you have a much larger interest rate sensitivity. A lot of the headlines about mass layoffs have been specific to the IT sector. So like Facebook, rather continuously announcing layoffs, it seems, for most of the last year. Interest rate decreases should at least arrest the bleeding there. And we have recently seen that the IT sector is improving slightly, but still a little premature to call a turning point on that, I think. And then for hospitals, major client for all of our healthcare staffing firms out there, while they've backed off from, of course, travel nursing, the pandemic is no longer such an issue. We don't have hotspots that need additional medical staff immediately for the next few months and then move all again to another location. So staffing demand there has fallen off as the health crisis has ended, but there's still strong growth relative to other sectors in hospital employment. So there might be some longer term potentials there, just not going to be the massive up and down as we had in the pandemic. And then Jeremy, did you want to add any commentary about what you're seeing in client verticals?
Well, just agreeing with you, the numbers don't lie. This is what we've been seeing over the course of the last couple of years. It was the run up was fun. The hockey stick growth it was really enjoyable in 21 and 22, and not to sound punitive, but the industry's kind of paying for it, has paid for it the last couple of years. Things just moderating. You couldn't have that sustainable growth for such a long period of time. It's just the market wouldn't tolerate it. One of the things that I like one of my understandings and the way that I talk about it with clients is that think about it with the growth in wages that happened because of the pandemic. For example, if you were sending 20 people to a client for X dollars, to spend that same X dollars, you might be sending them 12 right now because of the increased costs. So I think it'll come back, but seeing the value in the services that the industry provides, there just kind of need to be a level setting and a correction. I think that's a word that you'd probably use, Michael, in the economist space, but it works over here too. It needed to happen. I hate to say it, I don't mean to sound harsh. I'm the biggest homer for this industry, but it couldn't continue at that clip as much as we all would have enjoyed that. So I think we're getting there, and hopefully things are going to start to creep up as you have on this IT slide. We've seen that as well, that it's starting to come back, and hopefully some of the other sectors, manufacturing and warehousing, will come back too. As supply chains, now we know how much we need. We're not going from not buying anything to buying more than we need because we're hoarding and we don't know when the other shoe is going to drop. So kind of getting back to normal dealings, hopefully.
Thank you. And also with that, I'll be passing off to Jeremy to then help us navigate our very uncertain environment.
Yes, thank you.
Yeah.
So let's talk about what's ahead in 2024. We're going to do our best here. How that might impact the staffing industry that we all enjoy, and then 5 tips to be prepared and to help prepare your business for the uncertainty ahead. Turning that uncertainty, as Michael mentioned earlier, into really risk management, where we have the knowledge and things are less uncertain, if that makes sense. Michael mentioned earlier the 2024. It's not just election cycle in the great U.S. of A. I only point that out because we're not alone. I'm sure that there aren't. Well, I know SIA is an international organization, having attended the Executive Forum Europe in London in December. 30-some countries were there. So I know most people today are probably not as concerned about Madagascar or Maldives, but this is a phenomenon around the world that other countries are dealing with, wondering what's going to happen in November or whatever month elections are in. And actually in preparation the other day, talking with Michael, we actually kind of ruminating on this topic and how the election cycle might affect our industry. And generally speaking, at least my opinion is that there's not a staffing lean one way or another between the two parties in our country. Neither are anti. I think everybody wants full employment, with the one caveat that immigration is probably something to watch. It's been something to watch, especially in the light industrial manufacturing space. And there could be some outcomes, positive or negatively, in terms of the available workforce in that space. So that's probably an area to watch. I'm not saying that with a political bent. I'm just being factual that's something to take a look at. But if you're in a vertical that is not impacted by that element, then it's probably not a concern. So let's look ahead and start preparing for the coming year. Tip number 1, this is always a good idea. I'm sure you tell your kids this too when they get their allowance or what have you, but being smart with your money, keeping an eye on costs. always something important to do. But also considering the market conditions that you're in. Michael mentioned a moment ago that people are moving back to bricks and mortar shopping instead of e-commerce. Well, how about our friends in the staffing industry that are in offices like the one that I'm in right now? The commercial real estate market is getting socked, to say the least. And if you signed a lease pre-pandemic and your lease is coming due, you probably have the upper hand right now to at a minimum lower your cost per square foot and get a better deal on your wherever you might be. Or maybe that savings is something you can put into expanding your footprint geographically. So that's a pretty obvious one, that just taking advantage of the macro environment that we find ourselves in, and there's probably more landlords looking for tenants than there are the other way around. Refinancing existing debt. What are you paying for your money? Are there better opportunities out there? Are you leveraging your balance sheet properly to get the best deal possible? Whether you're with a traditional lending institution or a specialty finance firm such as Advanced Partners, what's that look like, and how does that fit into your budget? Should always have a budget, and this is a great opportunity. We're still in the beginning stages of the year to do forecasting and budgeting. Why is that important? Well, and this might be a little frightening to do year-over-year comparisons, but this is something that we do in our business, and obviously there's been some noise the last couple of business cycles, but I think it's important as a business owner and operator to do that routinely. Really having reliable numbers, so what are my cash needs? When are they going to be? Generally, people know that, but if there's an event that requires some additional cash on hand, or maybe a segment of your business is not pulling their weight in terms of the operating margin that you need, that these are things that you want to know and need to know to effectively run your business. Working your AR, something that's near and dear to me and my friends here at Advance. This is kind of why we exist, to help short-term cash flow needs for staffing firms. By definition, staffing is a cash flow negative business. The more you grow, you get rewarded with being tighter on cash. You have more profit sitting out there in your AR than you did before you grew. And is that something that can be remedied through keeping an eye on collections and turning cash quicker? Obviously, it's a fine line between infuriating your clients and banging the drum too hard. That's something that we're well aware of. We see that frequently, that you don't want to push too hard. But I think it's important to keep in mind that you are not in business to lend money to your clients. You're in business to provide them the best and brightest people out there, and not to be taken advantage of because of their payment habits. So I'm not vilifying anybody's clients. I'm saying that in support of the viewers today. Just something to keep in mind. It's a balance, and it's one that shouldn't be taken advantage of. So I say that in support.
Yes. I have a hunch that there's quite a few staffing leaders out there going, heck yeah, right now.
Yeah.
When you talk about revising your budget, Jeremy, I know that at SIA, here's a pro tip. We reforecast twice a year.
Yep.
Our forecast is coming out shortly. Michael, as Michael knows, he's been hard at work on it. And then we also forecast in September. What do you see your clients doing in terms of revising their budget or revising their forecast? I know that we also, just in terms of a P&L, we're constantly looking at where we are and readjusting. What are you seeing from your clients?
Well, I'll tell you what, we're seeing more frequent adjustments than before. And I think some of that's because of the volatility in the market. And I'll give a prime example. this is something I'll probably want to talk about further with Michael to get his input, but generally we see a seasonal decline in our client base in January, February. It's seasonal, holiday run-ups, and whether it be manufacturing, hospitality. It started earlier this year. It started in December, at least that's what we observed. So that kind of throws a monkey wrench into planning for, well, really the end of, depending on what fiscal calendar you have. Most staffing firms are on a 12/31, but makes it a little more difficult to predict what's going to happen this year when December, January was a little softer than expected. So aligning that with your fixed costs and your in-house staff that you need to take care of and keep them in a good spot.
Right.
I think it's not to make people crazy, but I think in the market that we're in right now, the conditions, I think there probably needs to be a little more frequent attention to it just to keep an eye on things. So if there's a sustained drop, for example, in a certain area, that you're not throwing bad money after bad, or you can make an adjustment, or maybe a vertical you're in is underperforming and you need to move some resources from one to another.
Yeah.
The numbers probably won't lie.
Makes sense. Okay, let's move on. Tip 2.
Yes. So know your terms. What are the payment terms on whatever vehicle you're using to finance your business? Obviously, a big part of that is the interest rate, and knowing if you're in a fixed fee or interest program or variable. Again, just talking a few minutes ago, if it's variable, the pain has probably been felt to the fullest extent, and there's probably some relief coming. But just understanding what that's going to look like. And again, I think most people are in agreement that when rates do come down, they're not going to come crashing. It's going to be subtle, and it's going to be somewhere probably in the middle of the road from where they were at both ends of the spectrum. So related to that, again, keeping an eye on cash flow. This really comes back to the budgeting piece too. Most staffing firms know when the lean months, when they're going to be down, but really being very intentional about that, and planning for it. And furthermore, if something's getting stretched out on your AR, for example, what impact is that going to have on other investment you need to make within your business? For each of those events, there could be a positive or negative impact. So just keeping your eye on the ball there. And then the facility, what's the structure? Is there a facility cap? Lots of lines of credit from banks and other institutions that you have a cap. How are you doing? What's the delta between your total availability and that cap? If you have zealous salespeople out there that are trying to make things happen and they close some big deals, are you going to have the capital within the framework of that facility to support that growth? And if you don't, or if you're concerned that you won't, the time might be now to look for an increase in your facility, so you're not caught in between when people start working and maybe your receivables stretch out a little bit. Just planning that as much as possible, so you're not caught in a tough spot. Tip number 3: exploring new revenue opportunities. This is a fun one. This is where we get to be innovative and think about how do we take what we already have that hopefully is great and making it even better. The logical one for many staffing firms is an adjacent industry that's sort of on the spectrum of what they're doing. Light industrial and construction, for example, those are I would say first cousins as our finance and clerical. They're somewhat related. I also love having conversations. One of my favorite things to talk about with clients, and we have some folks on our team who really specialize in this, is acquisitions. 2 years ago it was a seller's market, in the staffing space, and now it's more of a buyer's market. Is there a buying opportunity that is calling your name? Maybe it's a strategic opportunity where you can get into another segment that is, maybe there's some geographical congruency with the rest of your business, or I don't know, maybe it's something you want to dabble with, if it makes sense from a risk perspective. And then that's the build, or that's the buy opportunity. There's also the build. Do you find Michael Schultz, who's a salesperson in light industrial manufacturing and has a proven track record, and hopefully is unencumbered from a non-compete, non-solicitation perspective, of course, and you can thread the needle with that individual to build out a division and have them kind of light the path. So I think it's always good to be thinking about these things. I know most folks are not satisfied with the status quo and are always looking. So those are a couple areas that could be interesting. Upskilling yourself and your employees. So I'm a life learner. My silly comment about myself is that I'm like a piece of Swiss cheese. I have so many holes in my background. I'm always trying to learn, and I try to instill that in others, that we don't know. None of us are a finished product. So some of that is training and exposure to smart people, hopefully smarter people, in certain cases, and learning, but also infusing that in our employees, that they have that same zest for learning and gaining additional attributes, certifications, education. Is there a risk that you market them out of the company? Absolutely. But I think it's a risk that is worth taking. We always have to keep our employees happy. And I think that's, I don't care what business you're in, that's always extremely important. So that's part of that tip. And then outplacement. You can't turn on the news these days without hearing about layoffs at this place or that place. Call the hiring manager at those businesses and say, hey, send them our way. It's a win-win. If you're doing reductions in force, that's going to affect the company's unemployment rate, which staffing firms, we know all about that. Let's give them a soft landing and put them to work, so it's a seamless transition, and everybody wins. They're staying employed, and then they add to your role of your staffing inventory. I don't love talking about people as inventory, but I think you understand what I mean by that. Adding to your talent pool, because most staffing firms out there, they have way more orders than they do people to fill them. So this is another way to combat that. Being smart with taxes, reinvesting in your business. There are all kinds of tax credits out there that some you might know of, some you may not know of, that favor technology spend, and that's a great reinvestment. Excuse me, I'm losing my voice here. That's a great opportunity to reinvest in your business, maybe hiring more people. Another hot topic is tax reform. What is going to happen with the tax cuts from a couple years ago? Are they going to stay consistent, untouched? Again, November is probably going to have something to do with that. The counsel that I have for our clients is kind of assume the worst, whatever that might be, depending on where you come into the spectrum, and don't let it be a negative for you. If that can be avoided, just assume I'm going to have to pay higher tax rate, and build that into your model. The use of tax credits, work opportunity tax credit is the one that comes to mind. It's the most predictable. It's certainly the most predictable, especially those that have enjoyed what it has to offer. And really, that's a big part of that is just staying compliant, keeping your in-house folks current on keeping those forms fresh when you have new people coming through the door to get the forms filled out and submitted to the IRS in a timely fashion. I think well, ERTC has actually been around for a long time, but not on the magnitude that we have seen. I actually think that work opportunity tax credit is a better play anyway, because it's more foreseeable, and I can see the federal government using that as a better long-term retention tool than other things that we've seen in the last couple of years.
Could you, sorry to interrupt, Jeremy, could you define ERTC for those who aren't?
Sorry, yes. So the employee retention tax credit. So this is what many businesses, including staffing firms, enjoyed during the pandemic years and beyond, getting basically a refund on payroll taxes for keeping people on our payrolls, which staffing firms did it out of necessity. That's your cost of goods sold. That's how you make your money. So that was probably a one-time thing, at least to the magnitude that we saw it the last couple of years, and there's been a lot of scrutiny and fraud-related activities that I don't think we're ever going to see that again. Maybe with the exception of natural disasters, but the whole concept of that was keeping our people employed, and we can do that with work opportunity tax credit, which for qualified individuals, depending on their particular situation, just keeping them on our payrolls that earns tax credits for that work, and it's a little more digestible and consistent. It's certainly more consistent, and by the way, has survived multiple administrations for well over 30 years. So that's one that I think is well known, but should not be ignored.
Okay.
And then finally, tip number 5, focusing on building and maintaining relationships. This is what staffing firms do. You're in the human capital management business. You're all about building relationships, whether it be with your internal team members and nurturing that talent, or selling. That's what you do. So lean on that. Remember what you do well, and continue to do that, and make sure that you're rewarding your employees for that. I'm sure you are, especially after the ebbs and flows, the ups and downs of the last couple of years. We've all been through a lot there. Nurturing your referral list. One of my favorite things that I hear from clients is, I placed an HR manager at a client of mine, and now I'm getting all kinds of calls for orders because they use temps. Like that's a beautiful thing when that happens. Not that it can happen that frequently, but that's a fantastic referral source. And then also people in your sphere. I'm actually skipping because it's top of mind, but strategic partners, your lawyers, your accountants. These are people that always want to keep you as a happy client. But what a great way for it to be a win-win if they can refer opportunities where your services might be needed. And then naturally, clients. We always need to keep our clients happy, and not taking anything for granted. That there's always opportunities to improve on the quality, the value of the services that we deliver, and really keeping the pulse of what's happening there, and not being complacent. That's always important. So those are the 5 tips, and everybody today has the opportunity to download a white paper that we've had on our website, all about being prepared for financial uncertainty. Something we're very proud of, and I think it's a good read. It's not too long, and really highlights a lot of what I talked about today. And again, just kind of recap the key takeaways. Being smart with your money, knowing your debt structure, thinking about those new revenue opportunities and what's available there, being smart with taxes, and focusing on relationships. And I think a lot of this is probably things you already knew, but just really underscoring these key areas, I hope was helpful. And I hope you learned a couple things that, or at least brought a different perspective to the table. Just thinking about Michael establishing sort of the macro environment and staffing, and then me kind of getting into the trenches from the a friend of many staffing firms, just to hear what they're seeing and some thoughtful advice. So that was that's
Thanks,
what we had
Jeremy.
today.
That's great. I think that you've given us a lot to think about between the two of you. But our audience has some questions for you. I hope you're ready. Let's think about the first step with looking at different verticals. You mentioned different verticals. Everybody wanted to jump into healthcare a few years ago. What happened there, Jeremy?
Well, what happened was, if you weren't already there, it was difficult. It was difficult to get there quickly. The fortunate ones were the ones that were already there before the pandemic. So especially in travel, anybody who's in travel nursing knows that's a tough business. There's a lot of coordination that goes just beyond finding talent. So I still think it's a place that that you want to be. So I would not say avoid it. Hardly. Michael's graph showed the increased employment in hospitals, which is something we've seen over the course of the last couple of years. And if you've attended any of the SI conferences, particularly the healthcare staffing conference that's every year in November, one of the things that really stuck in my mind the last few years is the gap between supply and demand of staffing professionals needed for the healthcare industry. Not hospitals and long-term care facilities. It's getting bigger every year. So if you're ready to tackle that, I still recommend getting into it, because there's a tremendous need, and if you can access the talent, then go for it. Sort of different industry, but related, because it's highly skilled work, the skilled trades. So electricians, pipe fitters, plumbers, welders. There's always going to be a need for construction, and as the population of professionals that have been doing that work for many years ages, and birth rates are down, and immigration might be curtailed, we need more people in that space too. So the greater the demand for those segments, I think that's where staffing has its best moments. So I'm very encouraging of that. Not to say that I'm not encouraging of other areas, but just think about the economics, the supply and demand, where there's a scarcity of people with skills, special skills. Everyone has skills, but particularly certified folks. I think that's ripe for folks in our industry to get after it.
Michael, you want to weigh in here?
I'll underscore some of the points Jeremy just made briefly. So for healthcare, it continues to be the case, and there's probably no changing this, that the population globally and in the US is aging fairly rapidly. And healthcare spending and healthcare needs are, of course, pretty closely tied to population age. So there is a strong, very durable secular driving force for increased healthcare needs and healthcare staffing. Then for skilled trades, a lot of people don't realize this, but the number of people working, say, as carpenters, electricians, or plumbers collapsed with the popping of the housing bubble back in 2006, and then further fell with the Great Recession in 2008. It never recovered. And we have a lot more people. I think we have about 30 million more people in the US population than we did back in 2008. But the same number of housing units. There is a lot of pent-up need for construction, especially residential. With the decline in commercial real estate values, there is a trend where old office buildings are starting to be rehabilitated and converted into apartments. That will also drive some demand for skilled trades professionals. And with a bit of local level, like zoning reform, you'll see a lot more residential construction start to crop up. Now, it is, of course, contingent upon that permitting and zoning reform, but there is a massive need, especially for housing.
Yeah, and I would imagine that like home health care, call centers, all that other stuff that we've seen rise in the past will continue as well. All right, so let's move on to something else. Mergers and acquisitions. Interesting couple of years. What's on the horizon, guys?
I'll start. I think it's going to continue to be an active market. I think 24 will be more active than 23, which was lower than 22 because things got a little bit excited there. I think 22 was pent up from the pandemic and it was some catch up. I think that there will be a higher number of deals. I want to say it was low 100s last year, which was a little bit lower than 22 of reported deals within the staffing industry. I would expect it to be higher this year as people start looking ahead to cheaper costs of funds, and I think that there are sellers that wish they got out already, and maybe held on a little too long. I'm not saying that to be critical. There's no perfect time to do anything in life, but I think that there are good buying opportunities out there, and I think that if I'm a strategic buyer and I'm looking at this industry right now, I'm saying, hey, I'm catching it when it's been down for a little bit as an industry. It's a good buying opportunity. I'd rather buy in a valley than at a peak. So I think that's going to continue, and I think we're going to see a greater deal activity. And again, I recommend it. If it makes sense as a responsible means of expanding a staffing firm's footprint.
Okay. Michael, what do you see in your crystal ball for M&A?
I don't really have anything to add beyond what Jeremy just said for M&A specifically.
Okay. All right. So how do you explain the shortage of workers? Is it pandemic related? Is it the aging population in relation to the number of younger workers? What is it?
I'll jump in on this one.
Yeah, go for it.
So
You can have that one.
I wouldn't say it's so much pandemic related at this point in time, other than what got termed the Great Resignation and after effects thereof. A lot of the job openings are in sectors that normally have fairly low pay or unstable working conditions. And one thing to keep in mind for labor demand is that the vast majority of job openings are caused by workers changing to a different employer. It's not people that have never had a job or people newly entering the labor market that are taking the open jobs. It's usually people who already have a position who've decided they want to do something different. I think it's the leisure hospitality sector and retail trade, and by this I mean actual like grocery stores and such, are still below their employment levels from pre-pandemic right now because those tended to be unstable on hours and low pay. A lot of people went into entirely different sectors of the economy there. So stores and restaurants and hotels are still trying to fill that gap, but they still see a bit higher turnover in people coming in and then leaving the industry again. So as labor turnover overall has declined significantly, we're seeing less of a shortage, but just given the changes in relative offerings of what a given employer can provide to a worker, there's going to be structural shortfalls in certain sectors, I think.
Yeah.
And then likewise, population aging.
Right.
We have the highest prime age labor force participation that we've seen in about 15 years, but also a lot of people are retiring. And by prime age, that refers to workers between 25 and 54, so people that are done with any education they're going to do most likely, as well as not yet old enough to retire.
Right. A lot of boomers leaving the workforce. Okay. Well, I think we've gotten to most of our questions. If you guys have any other questions, you can go ahead and put them in the Q&A. But I think at this point, I want to thank Jeremy and Michael for your expertise. Thank you to Advanced Partners for sponsoring and presenting this webinar. And I wanted to also leave you with a few treats. From SIA, you can see Michael's report on staffing and the business cycle, get a review of the employment and U.S. macroeconomic environment right now. Our statutory expense tool might be of help to you. I think If you have questions about that, Michael's certainly the guy to ask. He's one of the authors of that report as well. We have our Staffing Trends 2024 that we publish each year, our March 2024 jobs report, and our global staffing market estimates and forecasts from November. However, my friends, we do have a new forecast coming out in just, I don't even know, maybe hours, maybe days, but it's coming soon.
First presentation of it will be at Executive Forum, and then I believe the webinar to present our new updated forecast set is, I think, on April 2nd.
Yep.
Yes, so that's for members only. So if you're a member, join us on April 2nd. And if you're not, well, become a member or come to Executive Forum. Jeremy, anything to add here? I know you have a white paper that'll be coming to folks to prepare, and Advanced Partners will be sending that. Anything else?
I just thank you for having me here and setting this up, and to any listeners and viewers out there, feel free to reach out. Love to have conversations with you and talk through what you're seeing out there and seeing if there's something that we can do to be helpful.
All right. Thank you to Advanced Partners, to Jeremy, to Michael, and thank you to our audience for tuning in and learning more about what can help your staffing business grow and be successful in the future. You can look forward to getting the slides and the recording about 48 hours following the webinar. And with that, I wish you a good rest of your day. Have a good day, and I hope to see you at Executive Forum. Bye.